Good morning, everyone. We're going to wait a few more minutes to let a few more people get on the line, and then we'll go ahead and get started. So just hold tight for a bit. All right, good morning, everybody, and welcome to the webinar. You've got myself, Kara Walton, as well as Lori Harbour, our president, here this morning. We will be spending some time today reviewing the findings from the second quarter survey for our production shops with a focus on future business readiness for human resources and technology. So we'll go ahead and get things kicked off. So first off, I know most of you are familiar with who we are, but just a brief reminder, we are a niche manufacturing consulting firm based out of Southfield, Michigan, and we focus on operations improvement, strategic development, and then all things benchmarking. So many of you know that that's powered by Harbour IQ, which is also the sector of Harbour Results that hosted this survey as we do quarterly. So just one thing I want to call out briefly for all of you to be aware of is last year we launched what we're calling Harbour IQ Standard. And this is our subscription model where we seek to share data and information similar to what you're getting on this webinar with everybody who subscribes. So with that, we send bi-weekly insights out, including things like updates on the state of the economy and the current state of tariffs and trade, as well as some business updates. So for example, what's happening with OEM earnings or what the forecast is for appliance. So if this is something that you're interested in learning more about, please let me know. And we'd be more than happy to send you a sample output so you can see the type of information that we push towards our subscribers on a bi-weekly basis. So with that, just a brief overview. Most of you are aware of how we run our surveys, but for this survey, we had 90 production companies respond, and then we also had over 75 tooling manufacturers. So as we talked about, this survey will be focused on production, but we'll call in a few details from what we found in the tooling survey as well. So to go ahead and get things kicked off, I'm going to do a brief overview of what we saw, what's happening in tariffs and trade and the economy over the last few months, just so we can get kind of level set ourselves. And then I'll go into some detail on the pulse and what we saw for the overall industry. And from there, I'll hand it over to Lori to talk about future business readiness in terms of this labor shift that we're seeing, as well as this technology shift that's coming down the pipe. So let's go ahead and get started. To kick things off, overall, as many of you have heard, the economy is doing well, but maybe not too well, right? So it's stable. The Fed just recently came out with their second annual Beige Book report, which is a very lengthy report that outlines the overall health of the US economy and then also a breakdown by region. Overall, this report found similar things to what we're going to talk about today, saying that the economy is stable and there are some good indicators, but also some not so good ones. So we're just watching to see where those are going to line up. So to start off, you can see here that interest rates are staying stable at this 2 to 2.5% range. This is still on the lower end, and as many of you know, we've had low interest rates for the last 10 years since we came out of that Great Recession. July marked the longest expansion we've ever seen in US history. So interest rates staying at this lower level, is perpetuating some of that economic health, but could also at this stage potentially perpetuate some not so good debt practices. So as many of you know, the Fed has recently been pressured by the US government to cut those interest rates. And although they are considering that, they're also watching other factors to better understand what lowering the interest rates again would do to some of the corporate businesses that may be managing their debt based off a very low interest rate for the last 10 years. So with that, the next piece that we're looking at here is the 10 and 2-year Treasury yield curve. So this curve generally represents investor confidence in the economy. So what it does is it takes the 10 and 2-year Treasury yield deltas and then plots those on a graph. And as that approaches zero, it begins to indicate the potential of a recession. Typically, when that curve crosses below zero or inverts, a recession occurs about 1.5 years later. Right now, that curve has been trending towards zero, but actually upticked last month. Now it went from 0.14% to 0.3%, so I'm not suggesting that there was a large uptick, but that could potentially be an early sign that the economy is still staying healthy and we're not going to hit that point of inversion or at the point where a recession comes 1.5 years later just yet. The next piece on here to focus a little bit specifically on manufacturing, the manufacturing PMI, so the Purchasing Managers Index, continues to trend towards 50, which is that neutral point where we see purchasing manager sentiment goes down once you get below that 50%. So now they're feeling a bit more negative about the state of the industry. So right now that number is still positive, but it is trending towards 50. And additionally, just a note on here, for those of you who are in Canada or who work in Canada, Canadian PMI has actually already dropped below that 50 point. So Canadian manufacturing PMI is now negative. They're on the negative end of it. So that's important for us to watch with the interrelationship between the two supply chains. The next piece on here is GDP. GDP is still sitting strong at a 3.1% growth rate. This is good news, and generally I was reading some forecasts recently that say that GDP growth could continue to stay strong in that 1.5% to 2.5% range for the foreseeable future if we come up with some trade agreements. So that's the big if that we'll talk about on the next slide, is that if we have a US and China trade agreement, then we could maintain strong GDP. But if we lose that agreement, that might be the opportunity or the chance that we would then see a little bit of a dip in GDP growth. The last piece on here, and then I'll move on to tariffs and trade, is consumer confidence. Consumer confidence is still sitting strong at 98, although it did drop a little bit from a very positive end to the first quarter. So it's still strong. Disposable income is still doing well, and we'll talk a little bit more about what that means in the tariff and trade section. So the next piece, just to give a brief update to everyone on the tariff and trade environment. For those stampers on the phone, you're probably already aware of this, but the tariff on dyes was originally at 10% and has now increased to 25%. So when the president chose to increase the tariff on that third tranche of goods, or that $200 billion list, dyes were included in that, and dyes were then tariffed at 25%. For all the molders on the phone, as you likely already know, there was a tariff on molds through the end of 2019 or 2018, excuse me, and on December 28th of last year, they chose to lift that tariff. So currently molds coming in from China are not tariffed. The next piece on here, as many of you saw, the president was discussing or considering imposing tariffs on Mexico earlier this quarter. The good news is that he chose not to do that, and across the board, that was good news for our industry, because as many of you know, if we were to close the border or impose tariffs, that would not only be a detriment to the North American automotive industry, but also affect our economy greatly. So overall, that's good news right now, and we hope that that mindset continues. The next piece on here is that the president was considering imposing a 25% tariff on a fourth list of about $300 billion worth of goods. And if he were to have done that, that would have tariffed almost all goods coming in from China to the United States. At this stage, between USTR testimony and a meeting that the president had with the president of China, they have chosen not to do that. And my understanding is that in the next few weeks, China and the US will meet again to begin renegotiating and better understanding if they can reach a trade deal this year. So hopefully we'll see something come through in that end. The last piece on here, and then I'll move on to the survey, is that Mexico has ratified USMCA. They actually ratified it with overwhelming support. The Senate vote was something along the lines of 114 to 4. So they were very supportive of it. Although unfortunately Mexico is the least of our concerns in terms of this agreement, we're watching closely to see if Canada and the US will be able to work out their differences and also pass the agreement. Our hope here is that this agreement will be passed in 2019, because 2020 we're coming up on a campaign year. And if we come up on a campaign year, there's a good chance that USMCA will get put to the back burner and other things will be prioritized. So with that, I'm going to go ahead and dig into a little bit on the pulse data from this second quarter survey. So we'll get started. The first thing on here, just a brief reminder of our methodology. You'll see some of these slides throughout the presentation. We use quartiles, so you can see that that average bar in the middle is, or the gray bar in the middle is where we have the average, and then 50% of the population sits between those two orange diamond endpoints. And then another 25% of the population is sitting above that upper endpoint, and the remaining 25% of the population is sitting below it. So just keep that in the back of your mind while we go through this presentation. To start off, we had a good respondent rate across the board with about 72 shops giving us full data and responses. We had a good cross-section of revenue ranges, as you can see on the left-hand side, and then we also had different shop types. Molding obviously was the majority, as this is consistent with our survey, although they were only at about 60%. So the remaining is stamping and other production. Just a note on other production, that contains die casters and machining or machine shops, and then shops who identify themselves as production other. We only had a few of those, but just a note when you're looking through the slides. So to start things off, you can see here that sentiment remained pretty flat quarter over quarter, and you'll see that there was just a slight dip down from 71% to 68%. You can see on the right-hand side that over 3/4 of the population that were surveyed are either optimistic or neutral. So similar to what we were talking about with the economy, things are good and stable, but they're not necessarily great, right? We're sitting at that 68% mark, and 50% is our baseline. So that's the positive negative threshold. So just a note on the tooling supplier side of it, when we did this survey for those guys, they told us that they had a pretty substantial drop in their sentiment. So they were a little bit more pessimistic than you guys are seeing here. They were sitting at 61%, which is about 7% lower than where production ended up in terms of an average. So to look at a little bit of what's driving that sentiment number, you can see utilization here. Utilization overall is maintained from Q1 to Q2, sitting at 62%. And obviously it only dropped a bit from the latter half of 2018. Now, one of the big things that I want to call out here is that you can see from the beginning of 2018 to 2019, utilization dropped nearly 10 points. So although we're sitting at this stable range right now in the start of 2019 and the end of 2018, we're sitting at a stable range that's significantly lower than where we were at the first portion of 2018. The good news to that end, though, is that production shops are forecasting an increase in utilization in the back half of the year up to 65%. So overall, hopefully we'll see a little bit of a busier back half of the year. And this is similar to what the tool shops are forecasting as well. So this is good news for us, but it's important to watch, and a little bit more of what Lori will talk about is what's coming down the pipe, right? So even if utilization does hit that 65% mark and it's upticked a little bit, what are we doing to make sure that our shops are staying efficient and profitable and meeting the future demands that are coming down the pipe? The last piece on here, and then I'll hand it over to Lori to talk about future business readiness, is overtime. So overall, you can see here that overtime ticked down again in the second quarter of 2019. This is generally a good story for us, right? Because as capacity drops down, shops responded and they also decreased their overtime. The big thing that we're watching here and hoping is that when utilization does increase in the back half of the year, like you guys have told us, overtime won't necessarily increase directly with it, and maybe there's opportunity for you to be more efficient on your shop floor and not just automatically increase those overtime numbers. So with that, I'll hand it over to Lori to talk to you about future business readiness and what we're seeing coming down the pipe.
Good morning, everyone. This second quarter survey that we did, we were sensing some changes in the industry and discussions of economy and tariffs as Kara just went through. And so we wanted to ask some questions that would help us better understand how ready companies are for sort of the changing dynamic of the industry. What we mean by that is that when you look at any industry today, everything is changing. Now, this picture is an automotive example, and everybody talks about autonomous cars and electric vehicles and ride sharing and just this whole new form of mobility. But in any industry we're in, whether it's the agricultural industry where we already have autonomous farm equipment, in logistics where we have autonomous vehicles that are moving moving containers around in shipyards and other areas, in medical where we have autonomous carts moving throughout hospitals. There is absolutely a change in industry dynamics that is being led by certainly technology and software, but also led by a new generation of consumer. And so as we look, no matter what industry you're in, when you face the changes of that, we wanted to understand kind of how ready companies are for that. So we asked the question of how many of you have strategic plans and things that are preparing you for the future. So as you can see, nearly 100% of every company, and that's over 80 shops, told us that they have a business plan. And then we asked about various components of a business plan. In our mind, a great business plan has a very robust sales process. It has a section associated with technology and how you plan to address technology in your facility for the future. And then it has a labor and hiring plan. As you can see in these three key elements of the robust business plan, frankly, it fell short for many of the companies that responded. So in our eyes, it's very difficult to say we have a business plan if we're missing out on some of these things. And in particular, the labor and hiring piece of it is probably what concerned us the most. So let's talk a little bit about labor readiness. As you look at any survey today in the marketplace, and we certainly asked it in this survey as well, we asked about labor challenges. Are you hiring? Are you having trouble finding people? And as you can see from this, in any production facility, well greater than 70–75% of the people in molding and other production are really struggling to find good qualified candidates, and they're finding a very tight labor market. I know from our travels and being in molders and stampers recently, there are a lot of companies using a temporary labor service more than we have ever seen, to the tune of 30–40% of their labor. So with everybody telling us in every conference and every survey that labor is our #1 challenge, for us, it was very odd that companies didn't have a labor and hiring strategy. So we also wanted to ask about what's the makeup of your facilities in terms of age distribution. So we asked you to classify where your manufacturing labor stood in terms of ages, and you can see the buckets that we've created. And frankly, if you compare all of your respondents, all of you who responded to the US manufacturing benchmark, it's really very similar. There's a very fair distribution across all age groups within all of your organizations. So this was, a pleasant surprise for us to see that people are recruiting the younger generation and we're managing a fair distribution. The reason this is so critical to us is that as you start to look at the changing dynamic of the workforce itself, most people don't realize that millennials and Gen Zs, which are those people who are under 37, 38 years of age, are currently representing about 43% of the workforce and are really the largest generation moving forward. They have the buying power today and they have control of many of the aspects of where our market and industries are going. Many people on my travels tell me, they sort of complain about the darn millennials and they can't show up on time and they have difficulty with them in training. And our concern moving forward is that those millennials and Gen Zs and those behind them, that is your workforce going forward. And so in order to be ready and prepared for the future, we have to start gearing our plans and our strategies towards that future, because they really are in control at this point of our industries and our dynamics in our market. So we asked people as a result of that, how prepared are you for this future workforce? And that could be how they behave or what their needs are. And we wanted to understand how ready people are. And as you can see by the significant amount of orange on this chart, people are saying we're somewhat prepared. Some people actually said we're not prepared and we're definitely not even prepared at all. You can see very, very little green on this chart where people said they're actually extremely prepared. So given the fact that everybody is struggling to be prepared for that change in workforce, we wanted to continue to dive deeper into this. So when you look at production facilities, we asked about how many of your workforce are actually apprentices. And I realize that this question sometimes is geared a little bit more towards a skilled labor question and people who are actually in maybe repairing molds or repairing dies and doing more skilled type labor. So it's not surprising to us that it's a 2 to 3% number for most of you. If we look at a tool industry, a die shop or a mold shop, it tends to be closer to 8 to 10% of their workforce that are apprentices. But the interesting thing, which is really in any industry across the board, as you can see, is that apprentice turnover is just very, very significant. We tend to bring in a lot of the younger generation workforce, but we're not able to retain them. We're not able to get them excited about the job that we've asked them to do and see the career path for their future. So many of them leave. What was more concerning for me was looking at the overall turnover rates of 15 to 20% within each of your companies. When I look at 15 to 20%, depending on how large your company is, this is a consistent turnover that your teams are dealing with on a regular, ongoing basis. So when I go back to that age distribution chart, I need to understand what age groups turnover is happening in so that I'm covering that in a very different way. If I look at the tooling industry, their turnover numbers tend to be below 10%. And so they don't have as much churn, and they're actually keeping apprentices longer within their facilities. So just another thing to consider as you look at how you retain young folks as you bring them in. So we wanted to understand how people are actually doing recruiting within their organizations. And obviously there's many different ways in which you can do recruiting. The number one method for most production facilities is job sites. So things like a LinkedIn or a Monster or a Glassdoor or something like that, where people are posting jobs on job sites and getting responses. Obviously they're partnering with schools and high schools and trade schools to bring folks in. And you can see as it goes down the path, what you see on the back end of this chart on the far right are what I'm going to term marketing related things, like what does my company website look like? How much do I use social media? Do I actually use trade show events? And you can see most people do not use trade shows, which is very interesting to me, because if you think about an MPE show or a Fab Tech show or a tooling event, there are thousands of young apprentices that walk the MPE show every year or the Fab Tech show, and it's a great opportunity to meet people who are looking for careers. So given that job sites was the most used method, we wanted to dig deeper into that. So our team went and looked at every one of you that responded to the survey and went on a site called Glassdoor, which I find that many people aren't even familiar with Glassdoor, but we went on to find out if you have a Glassdoor profile. Glassdoor is probably the #1 used site by millennials and Gen Zs today in the marketplace. As you can see on the left, of the molding facilities, it was about 34% of you that actually had a Glassdoor profile, and 38 in stamping, and then it drops to 18 for other production facilities. So not many of you even using the #1 used site by this type of workforce. So the next thing we wanted to look at is how many reviews you actually have and what your average rating was. So the blue bar is your average rating within Glassdoor, and then how many reviews you have. And the reason we looked at that is because as you look at this new generation of worker, they will consistently go to these sites and look for reviews. They tend to want to see 7 to 8 reviews of your company before they're actually even form an opinion about you. And so those of you who have 2.7 or 3, averaging 3 reviews, they look and go, that's not enough for me to make a decision on. I won't even consider the position. So it's really important to understand that if you have a Glassdoor and you have happy, content employees, they can actually go on there and put a very positive review on there for you. And so we start to look at this type of marketing and say, these are areas that you as production facilities need to consider to recruit the best folks. So to dig one step further, we asked about other types of marketing materials that your company is using to leverage and recruit people. As you can see, website and social media were the top tools for recruiting. However, 50% of companies are either not using them or not benefiting from them. And for us, it sort of frankly blows our mind here in this office that when you look at social media, 57% of the population is either not using it or doesn't find it effective. And I think we all know that the millennial and Gen Z population uses social media, I want to say on a daily basis, but it's probably more like hourly and minute-wise, right? So what we're trying to build the story around for you here is this significant connection of marketing and recruitment and retention of people. We really think that companies are missing the mark with recruiting this millennial group of people, and then subsequently the Gen Zs, which are also a very large portion of the population. Millennials will make up 50% of the workforce next year, and they are the people that we're choosing from. 73% use social media just to find a job. They visit 7.5 job sites just to do a job search. So if you're on Glassdoor only or you're on LinkedIn only, you're not covering that population. And the best companies out there, 93% of those are using website primarily for their recruitment. So when you look at this tie, most of the time when I go around to companies, we have an HR director and we have a marketing director, or we don't have a marketing director, we have a sales team, which many of you have heard me say before, sales and marketing are 2 completely separate functions. Interestingly enough, last week I went to a molder in Illinois, and they have made the decision that marketing and HR should be a combined function. The person in that organization that manages that, their title is Vice President of Brand and Culture, which means they oversee HR and they oversee marketing. And they utilize social media at a level that I've not seen. They did a post on Facebook for a job opening. They reached 26,000 people with that post, and they had engagements back and forth with 1,600 of those individuals that saw that job posting, and they spent $500 on that Facebook post. So when you think about the ability to join marketing with recruitment, it can really drive awareness and interest in your company, and then HR can work on the application and selection and hiring. So we're really challenging people to think differently about marketing and how you reach this next generation of worker. To further look at this particular fact, we asked companies, are you including HR in your strategy meetings? Are you working on things like culture? Are you targeting non-traditional workers? And are you increasing your online marketing presence? You can see the results of this. Again, Luckily, we're seeing more people include HR in their company strategy meetings, but still not enough. In our opinion, HR is one of the most critical executive team members that should be sitting at your table helping plan your future. Lots of people are working on culture. However, if you remember, I showed you earlier that we don't have a labor and hiring strategy. It's difficult to work on the culture for companies. And then when we see less than 40 or 45% of the people targeting non-traditional workers, so what do we mean by that? This is African Americans and Hispanics, it's women. It's a huge portion of the population that we're missing. We're not even targeting our recruitment efforts towards. And then, of course, the online marketing, which I've talked about already. Lastly, we wanted to talk to people. We wanted to understand from people how they're retaining talent. So, you know, we gave people some of the most obvious choices. And as you can see, for hourly and salary, people are using bonuses. They're using vacation time. They're using training and education, you know, at a fair degree as well. The biggest issue that we tend to see for companies is that it's these last two, right? The new generation of consumer and worker wants to have alternative work schedules and wants to work from home. Now, I realize the challenge in that. We can't make molded parts or stamped parts when people are sitting at home. But the opportunity to be able to look at alternative shift patterns and ways that we can staff our plant and ways that we can support them. We have some clients who have created teams of production, and within that team, they know they need to cover a certain number of hours of production. And among those 5 people, they figure out if somebody needs a day off, how they're going to be covered. And so there's really creative alternative things that are happening, and we're looking to have people start considering what can we do differently in order to support the changing dynamic. The bottom line of all of this is that, as I said, millennials are leading the workforce change. And although we get frustrated because they may be wired differently than some of the Gen X and baby boomers in the workplace, we have to understand that they're looking for something very, very different. In the past, the boomers cared about their pay and they cared about who their boss was and they wanted annual reviews. This next generation of worker wants to feel like they're adding value. They care about their development. They ask for ongoing feedback, whether it's daily or weekly, as opposed to an annual performance review. They don't care nearly as much about pay as people think that they do. There's a huge, I think the study was something like 80% of the population of, 90% of the 18 to 34-year-olds prefer benefits over a pay raise. And for them, benefits include health insurance, it means more vacation time or paid time off, and it means retirement. We even had a molder say that they had to, not had to, but they chose to institute pet insurance in their employee base because many of the millennials had pets and not children, and they wanted to make sure their pets were taken care of. So yes, it's a different form of things that they care about and are interested in, but we have to start designing our labor and hiring practices to those strategies as opposed to the old days of how we did it. So there's a lot more on labor in the actual report that we provided to those of you who completed the survey, but we wanted to just sort of summarize that for you. The next thing we asked about in the strategy was this sales process readiness. And the reason this is so important to us is because in today's current environment, as Kara pointed out, we've got government changes, we've got industry dynamic changes, we have an economic climate that is uncertain. And frankly, you're smack dab in the middle of all that, trying to figure out how to be competitive in pricing, how to fill up your plant with utilization, how to deal with, China or low-cost country markets. And that makes sales process and planning way more difficult than 20 years ago when sales, frankly, just used to come to us. So we wanted to look at the dynamic of those of you who provided data to us. And as we have said before, automotive still tends to be the 800-pound gorilla in the room. We have a lot of molders who provide data to us, but they're in a very mixed group of folks. So they're in medical and in appliance and other areas. But as you can see, as a total, automotive is still a large part of the production base, at least that we're interacting with on an ongoing basis. And because of this particular focus, I frankly have heard more people say to me in the last 6 months that they wanted to diversify outside of automotive, or things like I've never want to be in automotive again. And frankly, if I had $1 for everybody who wanted to change that, I would be very rich. So there's strategies going on to try to make that effort to change. And so what do we mean by sales process, and how do we take these numbers from 50, 60, 70% robust sales process to something more clear that helps drive our future sales? What you're seeing on the right is part of what we work with companies on strategically to develop a full sales process. Once we understand a company's strategy, we have to put sales plans in place. We have to develop a robust marketing strategy. We have to look at how we do pricing and quoting. It's not always a cost plus quote model. It needs to include some selling into open capacity. And all of that founded on the data analysis that we look at on a regular basis. So my analogy, or I should say my recent experience with some companies, is I have tried to connect some tool makers with some molders who have been looking for getting some new tools made. And as we went through the sales process, what I found is that some molders looked at tool shops and looked at their websites and were not happy with what they saw and decided not to go see that tool maker. I had a couple tool makers who I was bringing a new customer to who looked at the website of the molder and said, actually, Lori, I don't want to meet them because, I really don't want to do business with them. It was partially because their websites did not say who they are or what their values were or even what kind of products they produced. So the website, although I know you don't sell product through your website, if we think that people are not Millennial and the Gen Z generation, then we're crazy and we need to make the investment there. What's the messaging of your shop? What does your sales pitch look like? Again, if you don't want to be all automotive, then you need to make sure your website and your messaging and your sales pitch speaks to something that's more significantly focused on, the types of tonnage you produce or large parts or complex geometry, as opposed to, hey, we're the largest automotive molder in the world or something to that effect, right? So we need to think about those important messages. And then I always encourage people to look at customer visits. How you're preparing for those. I took a molder to 4 tool shops a couple of weeks ago, and not one of the tool shops even looked at the molder's website to see who was coming in to visit them. I realize I'm talking to a lot of you in the production side of the business, but you got to ask yourself, when your customer's coming in, do you do enough research to be able to ask intelligent questions and show that you've done the work? So this is what we mean by sales process. And for us, it's a very critical thing for each of you to look at as you build your strategic plan. Lastly, I want to talk about technology. Again, we ask people about how important is technology and do you have a plan to address technology? Frankly, I was quite surprised by 40% of the molding population that don't actually see technology as critical. Although when our organization talked about it and talked about our experiences at the MPE show last year, it kind of aligned with the fact that we really didn't see a lot of technology there for the future in terms of Industry 4.0 and the use of artificial intelligence and other things. So maybe there's some alignment there. But in turn, what we did was we asked everybody that provided data to us about where you are in this sort of technology adoption curve. So what you see in the blue is all of you as production shops and your responses, and the orange is sort of the traditional curve that you would see in manufacturing today. Of course, innovators are people who are out, investing in new technology that they may never see a return on, whereas early adopters and early majority need to know that there's some sense of return, but they're willing to take the risk. We looked at some of this and we dove into some of the data, and frankly, we felt like some people probably overrated themselves, and we think the curve looks something a little bit more like this. Obviously, it's each of your shops, right to rate yourself as you do, but when you really look at the definition of these things, we think that there's a lot of people who are very tactically running their business as opposed to looking at future technology and how to adopt it within their organization. We asked, again, there's a lot of other data in the full deck, but I wanted to just kind of summarize. We asked about different forms of technology and whether companies were seeing a benefit from the tech, what they've implemented first, and then what kind of benefit you were seeing. Probably not surprising to most of you that software is the largest implementation. So ERP, equipment monitoring, scheduling type software. So very consistently the top three things that you see. And the things are getting the greatest benefit from, right? Seeing your ERP system go well, monitoring your equipment. But as you move further to the right, you start to get into some of those future technologies. And before I go there, actually, the fourth one here is process improvement. So this is implementation of things that you think are going to drive efficiency in your business. Again, somewhat troubling to us that 42% of the population are spending money on process improvement that they're not yielding a benefit to. So we need to ask ourselves, what are we doing wrong as we're implementing those things in order to see no benefit? So as we move right, again, further technology, actually relatively surprised that about 45% of the population has implemented additive manufacturing. I actually expected it to be more. As you can see, 56% are seeing very positive benefits. And then it sort of drops considerably as we move to things like AI-based software, equipment, augmented reality, business intelligence software, things like Power BI and Tableau that people are not using. The few that are using it are seeing huge benefit, but we're not seeing some of that implementation. And as we asked about when we saw when these companies plan to implement them or see them as potential future, you can see some of those AI-related things are 10 years away from where we are today. And that, again, is somewhat troubling for us because the people who are implementing it are seeing dramatic benefits in their business, predictive maintenance and predictive scheduling and things of that nature by using artificial intelligence. So we really believe that the population is still very far behind in the adoption of future technology. The last thing we looked at was automation itself, and we asked people about where they see automation opportunities within their business. As you can imagine, most people see it specifically within assembly of parts that you're producing, as well as in the production side only. We are seeing people in scheduling and in areas like costing and quoting who have implemented automation and software to generate significant savings. And even on the tooling side, dramatic improvement on design and engineering automation. Not as much as we'd like to see, but some really neat technologies to help reduce time in some of those areas. So again, just encouraging people to think outside of the normal box that we're in and be able to look forward. Some of this new generation of employee, again, I have some customers who have 18, 19, 20-year-old automation engineers who are starting to look at areas like purchasing and costing and quoting to do automation. So this is a great opportunity to turn some of these young folks loose at implementing technology that some of us in the older generation wouldn't even think to do. So in the last couple of minutes, I wanted to just focus a little bit on the future forecast for the market. Kara talked a lot about where we see the economy and tariff and trade. Obviously, it changes on a pretty consistent basis, but we really are still relatively bullish about the economy. We're not predicting some massive recession, and if we do have what I would call more of an adjustment, we may see that next year or into 2021, but we're really not seeing that across most of our customers on the production side. Where we are seeing a significant drop right now is in tooling, and particularly focused on the automotive industry itself. The automotive industry is going through a very interesting period of time where they launched 180 products and now they have slowed as they're turning their focus to electronic or EV technology and autonomous technology. So there's a little dip in R&D. So what you're looking at is, we show this to you because although it's tooling and I know you're all production, this is an indicator to the future. So this is automotive vehicle launches broken out by 2018, 19, and 20. And you're seeing facelifts in orange, which means a minor change to the vehicle. In gray, you see major, so this is a significant change to the vehicle itself versus an all new in dark blue. And all of the new requires all new tooling and all new production parts. And the gray is 60–70% production parts and tooling. And we look at this on source year, which means you as a molder or a stamper or a machine house, you may get this sourced to you 24 months before start of production. You're going to source it 6 months later to a tool shop, and then you'll begin producing it, you know, for a start of production sometime out in the future. So what you're looking at for 2018 is the facelifts, majors, and news that were actually launched. And what you see in the red hatched bar above that is the quantity of launches that did not occur in the quarter they were planned to occur. So for example, the Chrysler Grand Cherokee was supposed to launch in Q4 of 2018, and it was probably $600 million worth of tooling, which of course then leads to a lot of parts. It did not launch in the Q4, and it launched in the late Q1. So what you're seeing is that the green line is kind of the capacity of the tool market in North America, and we have not been reaching that capacity for quite some time. So those of you in automotive maybe also have seen a bit of a slowdown in actual activity. We really do believe this is going to pick up in 2020 as we move forward, but it has been a very difficult year for the tooling industry, shops that are operating at 40, 50, 60% of capacity. And if you think on a more global basis, those tool shops in China, who particularly on the mold side no longer have a tariff for tools coming over here, have been dropping their prices because they too have not been filled with capacity. So they've been stealing additional work from our tool makers here in this country. We realize that many of you have to buy from China in order to win the piece price work from your customer, but it really has created a significant challenge. We've lost 10 shops to bankruptcy in the last 6 months, and there's been 2,000 to 3,000 people in the state of Michigan alone that have been laid off in the tooling industry. So it's having a huge impact overall. Again, I don't view this as a recession. I view this as a little dip in the product development cycle of automotive, and we see a lot of future in 2021 and beyond, or 2020 and beyond, with new products coming out from a source perspective. So this just summarizes a lot, some specifics of what we just talked about in terms of the products launch and this shift to AV. One point I'd like to make is that with this shift to EV and autonomous, we're seeing a little less visibility out of the OEMs. I think there's some uncertainty for them as to what's happening. And we're seeing some of the same thing in power sports and in farm equipment and Caterpillar. Heavy truck has had a little bit more activity these days because they're in the middle of their cycle. But most industries, as they're investing in new technology, are really struggling internally to kind of figure out their product development cycle. We have a lot of new entrants into the market for automotive, companies like Rivian and Canoo and SF Motors and Lucid and others that are launching tooling and new product into the marketplace. And some of the OEMs are struggling significantly. There's been some recent financial results that came out yesterday from Nissan and from Ford that they're really down in profitability, and Honda has removed shifts from plants. So OEMs that have traditionally been very strong are really struggling pretty significantly within their marketplace. So as we wrap this up, what we continue to share with companies in each and every one of our presentations is you as a company can only control the things that are within your peer view. You can't control the economy, you can't control tariffs, you can't control the shift in industry change to a different type of product and system. So you have to really focus on creating flexibility within your organization. You have to drive continuous improvement like never before. And frankly, every molder and every stamper I go into these days, I'm often disappointed that we've lost focus on continuous improvement, driving the right size of labor, making sure we have the right people on the bus and that they're in the right seats, that we're attacking overhead and waste at a level we've not done before, standardizing our processes and driving effectiveness of our equipment. I still hear companies talk about buying new equipment, and when we dive into their utilization, they're at 60%. So we need to understand how to run what we have at an effective rate and put in a replacement cycle where necessary. Secondly, we have to get our hunters hunting. Business is not going to come to us. It's more competitive than it has ever been. As leaders of your organization, you should expect a sales process and a plan from your team, and you stick to it. Create metrics to them that are leading metrics, not lagging metrics. In other words, how often are we visiting our customers? Are we asking them new questions like how we can support them in R&D and new product types? Or are we having the traditional sales call where we sit at our desk and pick up the phone and say, hey, do you got anything for me to quote? That's not going to win business in today's market. And then lastly, it's about gathering market intelligence and using it to focus your team. I realize it's not the easiest thing for people to get, and it may sound self-serving, but getting that market intelligence for your business is critical. Oftentimes we'll invite people to conferences and they'll say, sorry, we're too busy at our plant, we can't get out. And the problem with that is you don't know what's going on from experts in the market. And I don't mean just us, but other economists and a association that you're involved in, whether it's the PMA or the MAP group. We have to go to those events and make the time to work on our business and then bring that market intelligence back as one piece of the pie to help us develop our plans. So these are the things you guys control, and you have to work on these in order to be effective and flexible. If whatever happens in the market in the next 6 to 18 months, you're able to react and remain profitable. So at that point, that's all the information we have for you. I do want to thank our partners. As many of you know, we work with partners in stamping and in molding and in machining, and we could not do what we do without these guys. So we thank them, and at this point, I'll turn it back to Kara so we can facilitate some Q&A.
All right, so I'm going to be taking all of you off of mute. So with that, you can go ahead and ask a question yourself you should be able to unmute yourself on your end and then ask a question, or you can type a question into the question box. So you should be available to talk now if you would like to, and then I'm going to open up the questions as well so we can see those. So if anybody has anything, please let us know. And if you're talking and we can't hear you, then maybe try to type the question in if something's going wrong. All right, I'll hang on another minute to see if anybody has any questions. Otherwise, we'll let you guys get back to having a wonderful Thursday. Additionally, just a logistics note, this presentation and recording will be sent out to all of the attendees, so you're welcome to share these with your teams if anybody else would like to listen in that wasn't able to attend the webinar today.
And certainly you can also email us or send us questions. We're happy to respond to those as well. Our contact information is here on the slide.
All right, last call or else I'm gonna hang out. Goodbye, everybody. I hope you have a wonderful afternoon.